So here's what's really interesting about Silicon Valley Bank and the sell-off that we're seeing. I'm Rizek, CPA certified financial planner, and you've probably seen in the news and in the headlines that Silicon Valley Bank is going through a rough time. That's probably an understatement. So here's what happens with a lot of banks in the United States. They park a large chunk of their assets in US Treasuries and short-term bonds. Typically, Treasuries are thought of as very safe, secure investments. But listen, this is not a recommendation for you, this is just education, and I'm explaining from the bank's perspective, how they view things. So before we dive into Silicon Valley Bank and what's going on, you need to have a solid foundation of the pricing of bonds. I'm going to make this cool, and you're going to really walk away with some valuable insight when it comes to the bond market. So essentially, when you're pricing a bond, the value of the bond is based on a number of things. But if interest rates across the market go up, then the value of your bond, assuming it pays out a fixed interest rate, will drop. Why is that? Well, because everyone else in the market can go and get an investment that will pay them a higher interest rate as the Federal Reserve raises interest rates, right? That makes sense. As the market raises the yield on different bond products, then the cost of capital also goes up, and you, as an investor, get paid more and more. But if you're holding on to a bond from years ago that's paying a really low interest rate, and now the market rate is going up, the value of the bond is going to fall, all else equal. So what happened with Silicon Valley Bank? Well, Bloomberg reports that it took it to a whole nother level. It looks like half of all of Silicon Valley Bank's total assets were in investments, meaning the portfolio was way beyond the norm for the industry. So as private equity, venture capital, and tech startups are withdrawing more and more cash from their bank accounts held at SVB, the bank is now forced to cover those positions, essentially meaning they have to liquidate or sell those investments inside of their portfolio in order to generate cash to satisfy customer withdrawals. So what does that mean? The bank is now forced to sell those investments that have gone down in value at a loss. Bloomberg reports $1.8 billion in losses. Yeah, that's a lot. It's shocking to me that SVB had more than half of its total portfolio in treasuries and agency bonds. Let me give you one more thing to think about. As interest rates rise, that's a good thing for cash. So when you're looking at a place to store your cash, maybe a money market, a CD, or a high yield savings account will be on your radar. As interest rates rise, the yields on those types of products will also increase, meaning that the interest that your cash earns is going to go up. That's a significant cost and risk to the bank or the financial institution that you're going to use. Because for them, it's a cost that they're paying out to you. When the Fed raises rates, it is a lot more than just frees up the real estate market. Follow for more.